Welcome to the Realty Rundown, the podcast that cuts through the noise of the real estate world. Your hosts, seasoned industry experts Nick and Nate, are here to guide you through the entire process. Each week, they're breaking down the latest market trends, decoding complex jargon, and sharing insider secrets you won't find anywhere else. Whether you're buying your first home, selling a property, or building an investment portfolio, we provide the clear, actionable advice you need to make your next move your best move.
All right, everybody, welcome back to the Realty Rundown. I'm Nic Wyse, riding solo today while sipping from my Humane Society of Elkhart County mug here. If you caught us last week, you know I was interviewing Rob Leroy from the Elkhart County Humane Society and had some great conversation. If you didn't catch that episode, I recommend you go back to our YouTube channel and check that out. Anyway, today we're going to be talking a little bit more about economic signals, everybody's favorite subject. Things are getting a little bit weird, guys. So I just read an article this weekend about, stagflation. And the headline is ominous enough. So it says, stagflation recession is on our doorstep as interest rates surge. Some sensationalism in there for sure. Not an article that you want to pop open and have good rosy feelings about. And before you just go and start stocking canned goods and burying your cash in the backyard, I'm not saying that a recession is definitely coming, but there's some numbers, as the article will point out, that we're absolutely worth paying attention to, especially if you're thinking about buying or selling a home. So let's just touch on a few of those numbers right up front here. And the first one is inflation. We all know what inflation is. Sometimes it seems like a mystery of where it comes from, but the numbers just came back. The July inflation was 3.4%. which is better than June's 4.2%, but still we're way above that mark of 2% that the Federal Reserve has been targeting for a long time now. They've been wanting to get to 2%. We just can't seem to get there. Energy prices are a huge part of that, right? So energy costs are up 15% from just a year ago. Gasoline, like 25%. You know, there's no surprise to anybody that's aware of the conflict that's ongoing with Iran, right? That's an issue, and that's driving these prices big time. So the problem is these things directly affordability. They directly affect affordability for homeowners. We've got this strange position where economic growth is showing signs of slowing, and yet consumers are feeling the squeeze because inflation still isn't dead. And there's a word for when that happens, because it's a unique blend for when the economy growth slows and yet inflation remains stubbornly high. Stagflation. Say it with me, stagflation. Just a fun word. No, it doesn't sound good. Something immediately doesn't sound good about it. But the article, again, that I read, the author is definitely concerned about it. And where I see it getting interesting for housing is because we've spent the last couple of years, really, especially lately, waiting for interest rates to come down. But instead, long-term rates have actually been moving up to the point where we've got higher rates than we've had in a long time. So another number I'll throw out there, the 30-year Treasury yield just hit 5.31% on August 17th of last week. And again, according to that article, that's the highest since 2004. So 22 years since we've seen that rate. And mortgage rates, they don't simply follow what the Federal Reserve does. Mortgage rates are more heavily influenced by the bond market and these long-term Treasury yields. So when you've got an economy that's showing signs of slowing and mortgage rates still stay stubbornly high, that's the weird part. That's why we've got the title that we do for this episode about things are getting weird, because they are. So when you've got investors that are worried about inflation and government borrowing and energy prices and future long-term interest rates and long-term borrowing costs, when they stay elevated, that leads us to the problem of affordability. I'm going to throw some numbers out. If you got bored by those numbers, I think these will be a little more interesting for you. The article estimates that the household income needed for the average American home today is $124,700. I'm going to say that one again. The average income that a household needs combined, $124,700. Meanwhile, what is the median household income? $86,000. That's a big gap, guys. And just to put it into context, back in just 5 years ago, in 2021, the average income needed was about $69,400, and the average median household income was $69,700. So it was actually $300 more than what was needed, and obviously those numbers are balanced, $69,000, and we made $69,000. Now, today, we've got a $40,000 gap. And that explains a lot of what we're seeing, because people still want houses, and it's not necessarily a problem of demand. The problem is the monthly payments that people are being asked to make. And that's a result of higher mortgage rates. It's just completely changed the affordability question. And again, I know we've been saying for a long time, oh, these rates historically aren't bad. They're pretty good rates. But they keep getting higher, and they keep getting badder. And that's the issue, especially when all the other costs are going up as well, too, because of inflation and higher energy costs. And just to throw a couple other numbers out there that aren't super friendly right now, credit card delinquency rates are now 12.9%. So yeah, people that haven't paid and can't and aren't paying their credit cards, 12.9%. More than 1 out of every 10 person. Auto delinquency rates, people that are not paying for their cars, 5.5%. Again, these are very high levels, historically speaking. So consumer confidence shows to be extremely weak. And retail sales out there, sales at your Walmarts and even your Amazons and your Targets, as I call it, they're softening as well. So what does this mean, guys, for housing? What does this mean if you're buying or selling a house? Well, so 2 things to look at. For buyers, it basically means affordability remains your biggest obstacle. But there is some upside because of these higher rates. It's taking some buyers out of the market, which means inventory is improving. Buyers are generally having more negotiating power than they did during the craziness of the last 5 years. Here in Indiana alone, inventory is up about 13% from last year. Now, for sellers, don't freak out, because this does not mean the housing market and housing prices are collapsing, because in fact, in Indiana, the median prices were up about 5% during the first half of this year. And here in Elkhart County, through June at least, the numbers were up about 12.5% year to date. So home prices are very much still going up. The value of your home is still going up. You buy a home, yes, you may feel like you're paying an inflated price, but that price is going up rapidly. So we're not seeing the 2008 numbers and the fear that we had in 2008 and the recession that did happen in 2008, at least not based off the housing data that we're seeing. But it is important to know buyers are becoming increasingly payment sensitive, which means pricing a house when you go to sell is more important than ever, because you want to make sure you don't price yourself out of what's affordable to buyers. Guys, I'm going to continue watching this. I'm going to watch inflation. I'm going to watch the bond market, the mortgage rates, and more importantly, what is the consumer doing? Are they paying their bills? If the consumer keeps getting squeezed by higher prices and higher debt payments and higher borrowing costs, eventually that is going to show up in housing. So while the economy overall is throwing us some very strange signals, it's like Stranger Things here on the Realty Rundown this week. But while it's doing that, we need to keep a close eye on how that's going to affect housing. I'm going to do that for you guys. I'm going to keep watching. I'm going to get you your wise replies. Nick knows all that fun stuff is still going to apply. And you can always tune in Monday mornings right here, and we're going to get you those updates. All right, guys. Hope you enjoyed it. We'll talk to you soon.
And that's a wrap on another episode. Thanks for tuning in. We hope you had as much fun as we did. We love sharing real estate insights, but as you can see, we also love to have a good time. This energy and passion is what we bring to every client. Buying or selling a home is a huge deal, but it doesn't have to be stressful. With the right team, it can even be fun. Ready to make your move? Let's connect.